Quick question before we get into it. When's the last time you actually looked, really looked at where your money is quietly leaking out every single month? Not the big stuff, not the mortgage, not the car payment. I'm talking about the stuff that's so small and so routine you've stopped even noticing it's there. The subscription you forgot to cancel, the convenience you've been paying for since 2019, the insurance policy you've just never revisited. Here's the thing about being over 45. You've earned some stability, you've got routines, you know what you like, and that's exactly what makes this dangerous, because habits don't get audited, they just get repeated year after year, decade after decade, without anyone stopping to ask, wait, is this actually still worth it? Picture this. You're sitting at the kitchen table going through statements, and you realize you've been paying for a gym membership you haven't used since last spring. Or you're renewing your car insurance on autopilot, the same policy, the same rate for the 5th year running, never once shopping around. Or maybe it's something bigger, a whole life insurance policy you bought in your 30s that made sense then but doesn't fit your life now, and nobody ever told you that. None of these things are catastrophic on their own. That's actually the whole problem. They're small enough to ignore and consistent enough to add up to something huge. And by the end of this video, you're going to know exactly which 10 of these money leaks are the most common for people your age, what they're actually costing you, and, more importantly, exactly what to do about each one. Quick hello if you're new here. This channel is built for one audience, people 45 and up who are serious about getting retirement ready, without the fear-mongering and without the jargon. If that sounds like where you're at, consider subscribing. It genuinely helps this channel reach more people who need it. Now, let's set the stage. Picture two people, both 52 years old, both earning roughly the same income. One of them retires comfortably at 65 with money left to actually enjoy life. The other works 2 extra years just to catch up and spends those extra years a little stressed about it. Same income, same career length. What's different? More often than you'd think, it's not what they earned, it's what they quietly kept spending on without noticing. Here's the truth almost nobody says out loud. Most people have no idea what normal spending looks like at their age because nobody ever teaches you to audit your money the way you'd audit your health. You go get a physical every year, you get your car's oil changed on schedule, but your spending? For most people, it just runs on autopilot for decades. So that's what we're doing today, a financial checkup. 10 specific things that quietly drain people over 45, some obvious, some you've probably never thought twice about, and exactly what to do instead. Let's get into it.
Let's start with the one almost everybody has and almost nobody checks: subscriptions. According to data from companies like C+R Research and various banking surveys, the average American now spends somewhere in the neighborhood of $200 to $270 a month on subscriptions and recurring memberships. Not once, every single month. Break that down, and you're looking at somewhere between $2,400 and $3,200 a year, just quietly leaving your account for things you may not even remember signing up for. Streaming services you forgot you had, an app you tried once, a meal kit you canceled in your head but never actually canceled on the website. Here's the kicker. Most people, when surveyed, underestimate this number by more than half. You think you're spending $100 on subscriptions, you're spending closer to $250. Are you willing to actually go check your bank statement line by line this week? Let's talk about something bigger: whole life insurance. If you bought a whole life policy in your 30s or 40s because an agent told you it was a smart investment, you're not alone, but it's worth a hard look now. These policies often carry premiums 2 to 3 times higher than term life for the same coverage, with a chunk of that premium going toward fees and commissions rather than pure protection. For a lot of people over 45, the coverage need has actually changed. Kids are grown, the mortgage might be smaller, and a costly permanent policy no longer fits. This isn't advice to cancel anything today. It's a nudge to actually review it with a professional instead of letting it run on autopilot for another 20 years. Now here's one that stings a little: bank fees. The FDIC and various consumer banking surveys consistently show that Americans pay billions of dollars a year combined in overdraft fees, maintenance fees, and ATM fees. On an individual level, that can look like $11 to $35 per overdraft, multiple times a year, plus monthly maintenance fees of $10 to $15 on accounts that don't even need to charge them anymore, because free alternatives exist practically everywhere. Over a decade, that's easily a couple $1,000s paid simply for the privilege of using your own money. Here's what's interesting. This one is almost entirely avoidable, and yet it's one of the most common leaks there is. Let's talk about extended warranties. Retailers love pushing these at checkout, especially on appliances and electronics, and Consumer Reports has pointed out for years that most extended warranties cost more over time than the repairs they'd actually cover. You're essentially betting against the manufacturer's own reliability data, and the odds usually favor the house, not you. Next, high-interest credit card debt carried by choice, not necessity. According to Federal Reserve data, average credit card interest rates have been sitting north of 20% in recent years. If you're carrying a balance of even $5,000 at that rate and only making minimum payments, you could pay more in interest over time than the original balance itself. That's not a moral failing, that's just math working against you, silently, every single month. And here's one people over 45 rarely think of as spending at all: lifestyle inflation tied to raises. Research consistently shows that as income rises, spending tends to rise right alongside it, dollar for dollar, instead of the difference going towards savings. So the raise you got 5 years ago, for a lot of people, it never actually built any wealth. It just built a slightly nicer version of the same paycheck-to-paycheck cycle. Are you seeing a pattern yet? None of these are one big dramatic mistake. They're small, boring, repeatable decisions, and that's exactly why they're so easy to fix.
Let's keep going because there are a few more of these that are especially common once you hit your late 40s and 50s. Number 6, paying full price for insurance you've never shopped around on. Car insurance, homeowners insurance. Most people set it up once and just let it auto-renew for years, sometimes over a decade. Industry data from sources like the Insurance Information Institute has shown that shopping around can save the average household several $100s a year, sometimes more, simply because loyalty isn't actually rewarded the way you'd hope. Insurers count on inertia. They know most customers won't call around. Here's a direct question for you. When's the last time you actually got a competing quote instead of just accepting the renewal notice that showed up in your inbox? Number 7, carrying a mortgage well past the point it makes sense to. Now, to be clear, this isn't about paying off your house early no matter what. That's a personal call. But data from the Federal Reserve's Survey of Consumer Finances shows a growing share of people are carrying mortgage debt into their 60s and 70s, sometimes with refinances that reset the clock without anyone doing the math on total interest paid over the life of the new loan. Every refinance you do that stretches back out to a fresh 30 years can quietly add tens of thousands of dollars in interest, even if the monthly payment looks smaller. Smaller monthly, bigger total. That trade doesn't always get talked through. Number 8, and this one's sneaky: unused or duplicate insurance riders and add-ons. Roadside assistance you're paying for on your car insurance and your phone plan and your credit card all at once. Identity theft protection you're paying for twice because you forgot you already had it bundled somewhere else. These stack up in $5 and $10 increments that never show up as one big red flag on a statement. They just hide in plain sight. Number 9, dining out and convenience spending that's crept up without you clocking it. Bureau of Labor Statistics consumer expenditure data has shown food away from home spending climbing steadily for years, now representing a meaningfully larger share of the average household's food budget than it did a generation ago. Broken down, that's often $400, $500, $600 a month for a lot of households, not because anyone decided to spend that much, but because convenience is easy to say yes to, one order at a time. And number 10, maybe the most important one on this whole list, paying financial advisory fees you don't fully understand. A lot of people over 45 have accounts sitting with advisors charging 1% or more in annual fees without ever asking what that 1% actually costs them in dollar terms over 20 or 30 years of compounding. Here's the number that tends to shock people. On a $500,000 portfolio, a 1% annual fee isn't just $5,000 this year. Compounded over 2 decades, the difference between a 1% fee and a lower-cost alternative can total well over $100,000 in lost growth. I'll say that again, over $100,000 from a fee that looks tiny on a single statement. That's the full list. Subscriptions, outdated insurance, bank fees, extended warranties, high-interest debt, lifestyle inflation, unshopped insurance, mortgage drag, duplicate coverage, and unexamined advisory fees. None of these are about being reckless. Most of the people affected by this list are careful, responsible people. They just never got the invitation to stop and actually look.